Good afternoon and welcome to NYFP. U.S. stocks are holding on to session gains with the equity averages set for another consecutive week of gains. Joining me this afternoon is Peter Cardillo of Rockwell Global Capital. Peter, good afternoon. Thanks for joining me.
My pleasure to be back.
Well, U.S. stocks are higher today. We got some better than expected U.S. economic data releases. Consumer sentiment topped expectations, coming in at its highest since June of 2007. And we also saw leading indicators come in above expectations. But the question about a Fed exit does linger. So what do you make of today's action?
Well, look, there's no question that the Fed loudness is in terms of a possible early exit is amplifying on itself. And of course, yesterday, Fed Williams, as far as I was concerned, spoke on both sides of his mouth. I mean, at one point he said that the Fed could exit as early as June during the summer, and then he also said, but there's a possibility that the Fed may increase stimulants. So, that's been the rhetoric all along here. And I guess, the markets are really going to get concerned, and probably, the biggest event of next week is going to be Bernanke's testimony before the Joint Economic Committee. And so I think, the market is certainly going to take its cue from the Fed chief. And my guess is that he's going to repeat what he said all along. And so that takes us back to the technical aspect of the market, which continues to strengthen. And indeed, it was a week of, you might say, real mixed economic numbers until today. I must confess that the leading indicators moving up by 0.6% certainly took me by surprise. I was looking for a much smaller increase, and of course the fact that consumers continue to build confidence is another important factor. So, the bottom line is that this bull is not showing any signs of weakening, and he's probably going to continue.
You bring up a lot of important points. Next week we get the Fed minutes, and of course, as you mentioned, Bernanke's speech in front of the Joint Economic Committee. We also get the Bank of Japan rate decision and global PMI data out next week. Those will be flash figures for the month of May. But I do want to ask you about the ECB. Now, I know I've asked you this before, but given that there are ramped up expectations of a possible negative rate for the European Central Bank, what do you make of those comments?
Yeah, that's an excellent question, and I'm glad that you asked me that question again. Look, the gross domestic product in the Eurozone fell once again. It's the longest recession since the war. And if you look at the constructions numbers that came out this morning, out of the Eurozone, they were a total disaster. So, I believe that Mr. Draghi will probably loosen credit again, but I also think he's probably going to surprise the markets with some sort of stimulant. So I'm betting on that. And as far as the global economy is concerned, we're just chucking along. It's not growing. In fact, it may have slipped a little bit. So I kind of believe that the liquidity from central banks is going to continue for a while longer, and that's going to be positive for equities. That's been the basic fundamental of this stock market, and of course earnings as well. There's no question about that. But let's face it, there's just no place to put your money, and as long as investors continue to chase yields, they can only find that right now in the stock market.
And as you mentioned, we did see a consecutive contraction in terms of a GDP for the Eurozone. We did get the French and Italian GDP figures for the first quarter. And in the upcoming week, we'll get a better indicator of Germany's first quarter growth results next week. But last but not least, before we wrap it up, JP Morgan did raise its S&P 500 target for the end of this year to 1715. What do you make of that?
Well, there's only one thing that scares me, and that is that that everyone is singing to the same tune, and everyone is bullish. And sometimes, you know, the opposite can happen. I do expect a pullback from here, but a very mild one. But I concur that by the end of the year, and I've said this many of times in the past, that we're going to be at much higher levels. I'm not sure if we're going to see, you know, a 10 to 15% rise from these levels, but I think it'll be safe to say that we could see a 6 to 8% level, and so that basically takes us pretty much near what J.P. Morgan is talking about.